Hey traders, in this video I want to talk about the number one thing that's hindering new traders in the market. So to start 2021, we've seen more new accounts being opened in trading than we did in all of 2020. Schwab came out and said we're 5 months into the year, they've seen new account openings already exceed 2020. And I was having a conversation with a buddy earlier today who he just started trading. He retired a couple years ago, and he said, Lance, I joined a Discord server, I believe it's called, and he pays a fee per month. And he's like, I can't believe some of the stocks these guys and girls are trading and how many accounts get blown up. And I said, Dennis, what do you mean? He's like, these people are blowing up their accounts in weeks because they're putting up so much risk. And I kind of joked around and said, yeah, but they probably have, $200, $300, $500 accounts. He's like, no, Lance, they're trading $20,000, $30,000, $40,000 accounts gone in a matter of weeks into the market. So the bird's even laughing at the accounts being blown up. Now, I will say this. When I was a new trader, I blew up a couple of accounts. Now, granted, they were like $2,000 accounts. I was in college, and, that's expected, right? You want to either paper trade or trade small starting off. But for new traders, because we have so many, and obviously with the rise of option trading, I don't think a lot of people get risk management and the risk that comes with trading options, and especially these high volatile stocks. Like he was telling me, these people trade CAN, CAN, Riot, Mara, Discovery, Viacom, these stocks that move, 10, 15, 20% a day like nothing, these high growth stocks where they squeeze for one day and then they never go up again. And you have to realize when you're trading options, and I get it, guys, you want to trade the short-term options. I'm right there with you because they're cheap. You don't want to go out 30 days or more. A lot of people are drawn to the weekly options. And up until a few years ago, weekly options didn't exist because they were considered sucker bets. And that's why you see about 90% of out-the-money options expire worthless, because people think, well, I can buy a weekly option in, let's say, Riot, and it's only 70 cents, so $70. Or I could go buy the June option that expires in 45 days, and I'm going to pay $7. Right? So $700 of per one contract. So what are they going to buy? They're going to buy the 70-cent option because they figured, well, I'm only risking $70 per one contract, let alone they're usually buying, let's say, 10 contracts. So that's $700 of risk. And their account might be, let's say, $5,000 or so. So they're risking more than, 10% of their account on that one trade that expires this upcoming Friday in a matter of days, in a matter of hours. And if that stock doesn't move, 5, 6, 7% the next day, those options are to go down in value because they're buying cheap out the money options. And that's how you lose money. When you're trading, first of all, stocks that everyone else is trading that you usually read about online or you hear about on TV, you're trading against the smartest minds in the world. I want to be clear on that. And these smart guys aren't buying weeklies. I'll tell you that much. What they're doing is they're selling premium, so they're selling the options to you. So they're selling those calls that you're buying, especially those cheap out the money calls. And what they're doing, if they really like the stock, they're going out in time buying the call options, and then what they'll do is sell the weekly or the front month options, making it a diagonal spread or a calendar spread. Most people don't get that because they think, well, Bitcoin's going up, Riot, Mara has to go up. Bitcoin already went up. You're being reactive. You're reactive trading. So, guys, if you're new to trading or you're starting off, or maybe you've been doing this a couple years, use proper account management. I know ego is the number one thing hindering male traders. I'll say it time and time again. Guys, you have to kill your ego. I don't care what you do. Soak up your pride, swallow it up. I know you want to be a big dog and trade size because you want to be a millionaire overnight. And that's why, I will admit, I think females are better traders because they're better emotionally. They're more level-headed, and they don't have ego, which guys have. Trust me, I'm there. I'll buy 50 contracts, and I'll buy 50 more contracts, and I'll buy 50 more contracts. The stock keeps going down until next thing you know, I'm long 500 contracts, and now I'm sweating bullets every penny the stock moves. I've been there. I will fully admit. But if you have, whether you have $1,000 account, a $10,000 account, or a $30,000 account, I personally never like risking more, usually than 6 to 8% of my account per trade. And if so, that's a long dated option bet. That's an in the money or at the money option that has at least 60 days to work out. If I'm trading an earnings event, which is binary, we've seen 95% of companies in the S&P beat earnings, and only a very small percentage of the stocks have actually gone up because the market makers have been selling even good reports. Or I should say the market makers are pricing in the options with high implied volatility. Therefore, if the stock doesn't move above the market maker's expected move, the options are going down in value. So it's been very hard to be an option buyer, meaning buying calls and puts ahead of earnings this season, although we've seen fantastic earnings in the S&P companies out there. If you're trading earnings events and you're buying, let's say, a weekly option that's out the money, you should be trading very, very small size. Like, for example, if I have a 10, well, I'll use an example of myself, I should say. My account's around $60,000. If I'm trading a earnings event and I'm trading, let's say, a weekly option for earnings, outright calls, no call spreads or anything, I'm usually risking $200, maybe $300 maximum for that trade. So that's not even 1% of my account balance. You know what I mean? That's how small I'm trading. I don't think anyone, if you're even trading, let's say like today, I bought some Home Depot weekly calls. I bought a handful of contracts. That's it. They were about $2 each. So let's say $1,000. That's not even 2% of my account. And I know Home Depot's not a crazy mover, right? It's usually slow and steady, and they were at the money calls. If I'm buying a weekly option, I don't care what stock it is. I don't care if it's the greatest stock ever, and I'm super confident, I usually won't risk more than 2% of my account on a trade like that. Now, if I'm going out, let's say 45 days, and I'm buying, let's say a Kraft Heinz call option that expires in July and it's at the money, then I can scale up my position size because I know I'm buying an at the money call and a stock like Kraft Heinz that's not going to move, 3 to 4% a day. If it moves 0.5% a day, I'm probably going to make money on those call options, right, to the upside. So use proper risk management. I know nobody likes to talk about it. It's not a sexy topic. It's not the next, Tesla or NIO or some EV darling out there. But a lot of the stocks that rallied in 2020, especially to year end, a lot of those growth stocks that people got attached to and addicted to, and they said this is the greatest thing in the world, those stocks have gotten crushed. And what's worked in 2020 has not worked to start 2021. So if you're having struggle with your account, maybe you had a great 2020, scale down. There's no one's going to come and make fun of you because you're trading 5 lots or 10 lots out there, okay? Get the hang of it. Get proper risk sizing. Get moves in certain stocks that you're trading. Be aware. It's earnings season. You can have earnings affect an option like that. Those options can move up 50% or down 50% overnight. Be aware of analyst upgrades. Be aware of the market. Markets don't just go up. Even when markets go sideways, you can't make money on call options when markets are sideways. You need a quick, aggressive move to the upside. So if you have to employ strategies like iron condors or bull put credit spreads, or looking at long call spreads out there, there's nothing wrong with that. There's nothing wrong with trading spreads. Yes, your ROI is not going to be great as trading directional options, but there's certain times of the market where different strategies apply, and you just really have to get that down. If the market's breaking out, the market's trending, hey, great, go buy those long calls, go hit your lotto tickets, great. Markets ran, we're near all-time highs. How much more upside do we have in certain stocks? You have to look at, hey, we can see, down days, we can see sideways days out there. And if you're trading options, know that leverage is a double-edged sword. It can hurt you, or it could be very beneficial at the correct time. So hope this video helps. Use proper risk management, guys and girls. back to a beautiful night and some Malbec wine.